Should you be investing in dividend-paying stocks to create passive income for retirement and building wealth? My name is Colin Oveweg. I'm a certified financial planner, and let's dive into this question. I literally just had a client send me this email 5 hours ago, hence why I am making a blog video about this. I get questions all the time asking about dividend stocks, and basically they're saying, this is the thing I want to put money in, things that pay me now, pros or cons. Here's the link to the article, and the title is super juicy. Of course, it's saying invest $25,000 into these dividend stocks for $1,400 in annual passive income. That's about 5.7%, by the way. And on the surface, that's pretty cool. You got $1 million. You have dividend stocks paying 5.5%. You have 55,000 a year of passive income that you can it's a little more tangible, right? You see the income coming in. You're not touching the starting value or the principal of your investment. And the people who really like this strategy, I think, really appreciate not needing to focus on the stock price, because the stock could go up or down, but you're receiving that same dividend. So it feels like it's a little bit more sustainable. Do you like how I'm getting like baby wipe commercials and like golf stuff? Look, I'll be the first to admit there's some great advisors that utilize dividend-paying strategies. It's not for me, and I'll share with you why. And the first thing is you kind of have to think about what companies are you owning that have nothing better to do with their net profits. So they have revenue, expenses, and then net profits than to just give their shareholders a thank you present in the form of a dividend. A lot of the best companies in the world, the Apples, Googles, Amazons, Microsoft, pay very, very to low dividends. Actually, Warren Buffett and his little company, Berkshire Hathaway, famously doesn't pay any dividends and basically just feels that it's better for them to invest back into the business to provide more long-term value to shareholders, aka they're trying to innovate, they're trying to buy other companies, they're running their business trying to increase the stock price. So comparing a standard S&P 500 index fund that has a yield of about 1.1% to a Vanguard high dividend ETF that has a yield of closer to 2.6%. Over the last 20-ish years, the S&P 500 as a whole has just smoked in total performance, including all of the dividends, against just a high dividend US ETF. Josh Brown actually wrote a great article about this earlier this year and summarized it pretty well, saying dividends are a feature, nothing more. Josh also points out that dividends are not guaranteed. Sometimes they get cut, and tells a story about a steel company that everyone loved because of the high dividend, but really it wasn't that they were being so generous with the dividend. It's because the stock price had gotten so low that the yield became such a massive percentage of their net profits. Long story short, the steel company is now a casino. From a high level, the strategy here is that if you had $1 million, you can go into a dividend yielding ETF paying you 5%, that's 50 grand a year, that's great. Or you could go into an index fund, maybe S&P 500, pays 1% dividend, so that's only 10,000 a year, and then you withdraw an additional 4% to get to that same 50,000 per year of passive income. The only difference is that the passive income is coming from selling the stock versus just receiving a dividend. I think that's a point that people really get confused, that they actually do have to be selling the stock. And that sounds scary. But when you look at the total performance of a dividend-paying stock versus just the standard S&P 500, you can see that the total return is substantially higher. I mean, these things were trading in tandem for a long period of time. So again, I'm not bashing one strategy or the other, but boy, the total return in the last 5 years is really prominent here. People might argue that dividend yielding stocks are more reliable, and here's just a volatility chart. What you can take away here is that they're almost identical. If you're holding these two ETFs, you're not going to notice on a day-to-day basis that one is more or less volatile than the other. Josh points out a lot of things that even my client recently said, that maybe clients are getting older and they prize the income more than returns. That's a very understandable reason. It makes sense. It's logical. Dividends are more reliable than just revenue growth or innovation. Kind of speaking to, would you rather have a company paying you a dividend, a thank you present for owning the stock, or do you want Berkshire Hathaway where they take all of their profits and put it back into the company? And this is what I was just talking about. I'd rather use money from dividends to withdraw and live off of as opposed to having to sell a chunk of my stocks each year to pay my bills. Josh's response, plenty of former high quality companies pay steady dividends on their way to becoming lower quality companies. Basically kind of that example of the steel company. Points out the double taxation of basically a company has to pay tax on their profits and then they give it to you as a dividend as a thank you present and then you have to pay tax on it. It's a very inefficient way of handling your profits as a company. And this really summarizes my feeling of it. The role as a financial advisor, me, is to optimize withdrawals for a retired investor. Okay, I'm trying to create you passive income in retirement. I'm not trying to make you feel good that none of those withdrawals are coming from the principal or selling the stock. Good advice means telling people why their instinct is wrong, not feeding into their wrong ideas for the sake of getting them to say yes. I want you to own the orange chart, not the purple chart. And if that means owning the orange chart is going to have to tell you that your strategy is incorrect, I'm going to be the advisor to do so. And this really summarizes the whole thing. Dividends are good, but total return is what matters. Focusing predominantly on dividends means giving up a lot of the upside of what the stock market has to offer. Very much not against dividends. I love them, but they are a feature, nothing more.